Stability is never accidental. When markets remain calm while the rest of the world convulses, it isn't luck, and it isn't magic. Here's what nobody tells you. Stability is engineered long before stress arrives, and enforced long after it becomes uncomfortable. That is the secret behind Singapore's market reputation, and why it continues to confuse observers who mistake calm for passivity. This is where the pattern begins. In the 1960s, Singapore had none of the advantages associated with financial power. No natural resources, no hinterland, no domestic market worth speaking of. In 1965, when it became independent, unemployment exceeded 10%, and GDP per capita hovered near $500. Failure wasn't theoretical, it was the base case. Yet instead of chasing growth first, Singapore chased credibility. And that choice shaped everything that followed. Here's why this matters. Most economies try to grow their way into stability. Singapore reversed the sequence. It built stability to attract growth. That meant enforcing rules that felt unnatural in boom times and politically dangerous in downturns. Wages were restrained. Savings were forced. Speculation was discouraged long before it became fashionable to warn against it, not stimulus. Structure. Let me show you exactly how this played out. By the late 1970s, Singapore had established mandatory savings through the Central Provident Fund, locking in long-term capital formation while reducing household fragility. By the 1980s, fiscal discipline wasn't a slogan, it was a constraint. Budgets were balanced across cycles, not years. When recessions hit, the response wasn't panic spending. It was controlled intervention, paired with signaling that rules would not change midstream. At first, it looked like underperformance. Then the bill arrived elsewhere. During the Asian financial crisis of 1997-1998, currencies collapsed across the region. Capital fled. Markets broke. Singapore slowed, but it didn't fracture. The reason wasn't immunity. It was trust. Investors believed the rules would hold even under pressure. And when belief holds, capital pauses instead of running. Not growth at all costs. Credibility at all times. That distinction is the core of the system. Singapore's leaders understood something many governments ignore. Markets don't fear losses as much as they fear unpredictability. You can survive a downturn. You can't survive a rule change. Everyone thought they were safe. They weren't. Across Asia, countries that relied on rapid expansion and short-term inflows learned that stability borrowed from confidence disappears the moment confidence fades. Singapore learned the opposite lesson decades earlier. It made markets boring on purpose. And boredom, in finance, is strength. Here's the mechanism. Stability is psychological before it is financial. It comes from repeated reinforcement that incentives won't shift when pressure rises. Investors internalize this. Businesses plan around it. Citizens adapt to it. Over time, the system trains behavior. Risk-taking becomes calculated. Excess becomes socially and institutionally discouraged. But this isn't free. Here's the trap. Stability demands sacrifice, of flexibility, of speed, of political theatrics. It requires saying no during booms and holding the line during pain. Many countries try to copy the surface features of Singapore's model without adopting the discipline beneath it. That always fails. The danger wasn't what they saw. It was what they misunderstood. Singapore's calm isn't the absence of force. It's the product of constant enforcement, quiet, methodical, and relentless. And the unanswered question isn't how Singapore achieved stability. It's whether that stability can survive a world that increasingly rewards disruption over discipline.stress doesn't destroy systems. It reveals them. That truth explains why Singapore's calm has survived shocks that shattered far larger economies. The secret isn't that Singapore avoids crises. It's that crises arrive and find no weakness to exploit. Here's what nobody tells you. Stability only works if it's believed to be non-negotiable, even when abandoning it would feel easier. This is where the pattern becomes visible. After the Asian financial crisis, Singapore faced a temptation most governments fail. Growth slowed. External demand weakened. Asset prices softened. The political incentive to loosen rules was enormous. Many neighbors did exactly that, chasing relief through debt and stimulus. Singapore didn't. It adjusted margins, not principles. That choice looked conservative. It was actually aggressive. Let me show you exactly how the hidden mechanism works. Singapore enforces what some analysts describe as a credibility loop. Fiscal discipline supports currency confidence. Currency confidence lowers capital flight risk. Lower risk reduces the need for emergency intervention. Reduced intervention reinforces trust. The loop feeds itself. Break it once, and the system has to relearn belief from scratch. At first, it looked like restraint. Then, the bill arrived elsewhere. During the global financial crisis of 2008, Singapore's economy contracted sharply, by more than 3% in 2009. On paper, that looked like failure. In reality, it was elasticity. The system bent, then recovered without rewriting its rules. Within 2 years, growth returned and capital flowed back. Investors didn't panic because they understood the script, not immunity. Predictability, that's the distinction. Markets don't reward perfection, they reward consistency. Singapore doesn't promise investors high returns. It promises rule continuity. And in a world where policies shift with headlines, that promise is rare. Here's the comparison that reveals the trap. Other economies have attempted stability by design without enforcement, pegged currencies without reserves, balanced budget laws without political discipline, regulatory frameworks that dissolve under pressure. They copy the architecture, but not the behavior. When stress hits, they flinch. Singapore doesn't flinch because it trained itself not to. Here's why this matters now. Some analysts suggest that global markets are entering a period where volatility isn't cyclical but structural. Debt levels are high. Political trust is thin. Policy reversals are frequent. In that environment, Singapore's model becomes more valuable and harder to replicate. Stability requires social buy-in, institutional memory, and tolerance for unpopularity. Here's the mechanism again, stripped to its core. Stability is enforced psychology. Citizens accept constraints because outcomes are credible. Investors accept lower upside because downside risk is controlled. Politicians accept limits because breaking them carries reputational cost. The system works because no single actor can override it without consequence. Here's the trap for imitators. You can't install this model during a crisis. It must be built before one. Rules created in panic are seen as temporary. Rules enforced during prosperity become permanent. Singapore did the hard work when it didn't have to. That's why it works when it must. The danger wasn't what the world ignored. It was what it underestimated. Stability isn't passive. It's exhausting. It requires constant resistance to pressure, temptation, and populism. Many societies prefer volatility to discipline because volatility offers hope. Discipline offers predictability. Here's the final question. Can other nations adopt this model in a world that increasingly rewards speed, disruption, and narrative over restraint? Or is Singapore's stability a product of timing, scale, and cultural alignment that can't be exported? Because if stability is the rarest asset in modern markets, then Singapore's real secret isn't how it grew. It's how it said no, again and again, until belief replaced fear.